Good morning, or not good morning, but dober dan. That means good day. This is TalkCast PDX. You can find us on the web at talkcastpdx.com. It's Tuesday, June 22nd. The name of the show is The Bogdanich Perspective. I'm your host, Paul Bogdanich, and welcome. I'm going to start with the news that isn't department. You won't see it in the paper or the press or whatever, but it's June 22nd. So 2021, so 80 years ago, June 22nd, 1941. Operation Barbarossa, the German invasion of the Soviet Union, kicked off at about 5 a.m. in the morning local time. Crossing 4 million men, 5,000 tanks, 6,000 aircraft, 25,000 artillery pieces, 600,000 trucks, advancing across an 800-mile front, which on the modern map runs through Romania, the very western part of Ukraine, and up into Latvia. Local time, it's 10 hours later. We're sitting here, and they would have advanced maybe in between 100 and 200 miles. 3 army groups, north, center, and the south. Army Group Center, 2 prongs advancing towards Moscow, 1 prong just south of Minsk, the other advancing towards the Dnieper River just south of Kiev. Army Group South pushing towards then Stalingrad, and Army Group North, St. Petersburg. But the sky was full of combat aircraft and started the largest land invasion in the history of the world. And somewhere in Germany or in Romania or somewhere, there's a very old man who was part of that, still alive. I'd be surprised if the number were more than 5. But anyway, title of today's show is Dazed Confused. Fed had its meeting last week, its summer meeting, and it came out and it did its they did their press conference, and they raised a couple of the technical interest rates and kept the main rate steady. And I didn't see any clear direction. It seemed to me as if what they did and what they didn't do were kind of at cross purposes, pulling. Didn't appear that they had a clear direction. Confused me. I mentioned last week that I saw an anomaly in the trading pattern on June 11th, which was not last Friday, but the Friday before that. Markets are down all the day, and then in the last hour, they soared and closed up 0.2% to make a new all-time high. And when you see that in a single stock, what that means is that there's a very large buyer, and all the traders are accumulating the positions all across the day, and then they give them to him over the last hour, or the ultimate buyer over the last hour. And to do that with the entire market takes a buyer that's very large. So it had to be a central bank, the Federal Reserve, BlackRock going all in, Renaissance, somebody like, just a huge buyer. And then again this last week, kind of the same deal. Markets are down. And this was during the Fed meeting sometime, either Wednesday or Thursday. But markets are drifting down. They weren't down a lot, but they were drifting down. And at 1 o'clock, they picked back up, and they went up to where they were, and then they held that level through the end of the day. And if you see that in a individual stock, what that means is heavy ETF buying. ETF is just what's called an exchange traded fund, but what happens with those is the committee gets together and they operate by charter. They're not allowed to hold more than 2% of the fund's assets in any particular stock. So they get together and they decide what to buy, what to sell, and then they pass the order to the traders, usually about noon, a little after, and then the traders hit the market with it about 1. But to have that in the whole market, again, is a surprise. You see it all the time in individual stocks. But to have that market wide, again, indicates enormous volume of ETF buying. And I know that the Fed has authority to purchase ETF funds. So I'm confused. Are they tacitly supporting this market, at these high levels? Which means that my worldview is a little bit off. And to top it all off, Friday morning, I got surprised. Just Friday morning, I was up. I was going to go get a cup of coffee. The place where I went to get a cup of coffee has a newspaper stand. And on the newspaper stand, there was the local paper above the front page. And it said holiday today, Juneteenth holiday. And I had never heard of that. And I asked the person, the clerk behind the counter. He was much younger than I was, and he didn't seem to know what it was, other than today was a holiday. In the ancient world, an omen was something that wasn't of any significance to the broader population or the other people around, but something that made an impression on whoever it was that received the omen. And that's kind of the way I looked at that headline. I was very surprised. And kind of like, one of those moments, it's early in the morning, I haven't had my coffee, but you're thinking like, did I get dropped in a parallel universe, again, or something of that nature. But two things about this concern me. Not the holiday itself, it's a June holiday, fine. But what about the observance? This year, the holiday fell on a Friday. Nobody observed it because it was, a surprise, as near as I can tell. But if you look at the market and the holidays, bank holidays and market holidays, there's 12 of them. And they're mixed. Like on Good Friday, the market is closed, but the banks are open. On Columbus Day and Veterans Day, the market is open, but the banks are closed. And then you have your 12 holidays. Of the 12, 4 are on set dates. You have Christmas, which is always December 25th. 1 week later, you have New Year's, all right, always January 1st. Then the 4th of July is always on the 4th of July, and that can be on a Monday or a Tuesday or a Wednesday or a Sunday or a Saturday. If it's on Saturday, it gets celebrated Friday. If it gets on Sunday, it gets celebrated Monday. Every time else, it's just whatever day it falls. Same with New Year's, Christmas, and Veterans Day is always November 11th. But every other holiday is flexible. Good Friday is always on a Friday, but the date is picked by the church rather than the government. But Martin Luther King Day is the third Monday in January. President's Day is the third Monday of February. Memorial Day is the last Monday of May. Labor Day is the first Monday of September. Columbus Day is the second Monday of October. And then Thanksgiving, of course, is the last Wednesday in November, usually the 4th. But what are they going to do? In other words, in terms of observance, the actual holiday itself is on June 19th, as I understand it. It was originally celebrated in Texas. The custom of the people in Texas for the last 100-odd years or whatever is to celebrate it on a Saturday, but they can't do that. So I don't know what they're going to do in terms of observance. I thought that when I read the press, that like every other time I read the press, that it's deficient. And so I went and I looked at the authorizing legislation. I thought for sure, somebody must have thought of this, right? You declare a new holiday, when are you going to observe it? The authorizing legislation was surprisingly short. I'm just going to read it to you. Quote, a bill to amend Title V United States Code to establish Juneteenth Independence Day as a federal holiday and for other purposes. Be it enacted by the Senate and House of Representatives of the United States of America in Congress assembled. Section 1, short title. This act may be cited as the Juneteenth National Independence Day Act. Section 2, Juneteenth Independence Day. Section 6103A of Title V, United States Code, is amended by inserting after the item relating to Memorial Day the following, and then there's a colon, and then in quotes, Juneteenth Independence Day, unquote. That's it. That's the bill. That's what cleared Congress. That's what the president signed. That's the holiday. That's the bill. when does it get observed? So, all right. So I read the bill. There's nothing in the bill. I go and look at like the Federal Reserve. All right. Because they're in charge of whether the banks are going to be open or closed. All right. Do they have anything? And they had a press release out that said, literally, and I quote, they're quote unquote considering it. All right. Did this thing get costed by CBO? No. Is there a schedule out from Department of Interior or HHS? No. No guidance on it at all. And it just, when I saw it in the paper and then learned all that kind of thing, it struck me as like an imperial edict. Like the king woke up in a good mood and said, let's make it a holiday. Just, I have complete authority over everybody and everything. Why not? Right. And it's just struck me as very odd. Changes things a little bit, but it's not, like I said, it's a summertime holiday and I'm sure they'll figure it out by next year. But I found, like I said, to me, it just struck me as an imperial dictate. Didn't understand it, confused me. Let's look at the markets. Not last Friday, but the one before that, June 11th, the market rose 0.2%. That's the day that it was down, and then soared up during the last hour of trading. But closed up 0.2%, new all-time high on June 11th. The following Monday, which was the 14th, it rose 0.2% and closed at another all-time high. And then Tuesday, the following day, I did my show. And the market fell 0.2% that day. The Fed started their meeting the day after, Wednesday, and the market fell 0.5% on that day. The Fed was still in their meeting. It's a 2-day meeting on Thursday, and the market was absolutely flat on Thursday. And then the Fed got out of the meeting and made the statements and all that stuff, and the market fell, I think it was 1.3% on Friday. That means that for last week, the week ended June 18th, that the market was down 1.9%, 1.91%. And on a $100,000 portfolio like we have, you would have been expected to lose about $1,900, which is quite a bit, almost $2,000, but $1,900 on average. We had 4 portfolios, the top 30 equal weight and cap weight, which are just the top 30 stocks in the S&P, which is more than 50% of the market value. One is cap weighted, one is equal weighted, because those portfolios do not have any stocks in industrials, materials, real estate, or utilities, no stocks in those sector. They only have one in energy, and so on. So to correct for that imbalance, we created a third portfolio, took all 11 sectors from the S&P, 3 stocks per sector. Call that one the top 3 by sector. And then I have a discretionary portfolio I call the large liquid leaders. But if last week the market was down 1.9%, so you would have expected a hypothetical $100,000 portfolio to fall $1,900. The top 30 cap weight, which is a proxy for the largest stocks in the S&P, only lost $233 instead of $1,910 or $1,900. So very good performance there. If you look at the particulars on that, you had 4 stocks that lost $690 for the portfolio, and those were JP Morgan, Berkshire Hathaway, JP Morgan losing $235, Berkshire Hathaway losing $180, and Bank America losing $163. And this portfolio only has 3 finance stocks in it, and those 3 finance stocks were the 3 largest losers. And that's, finance was down last week. The sector as a whole was down 6.5%, 7%. So that was the main one, probably the main drag. The fourth loser in this particular portfolio was Google, lost $112. And then it had 2 winners, but the 2 winners contributed $722. Amazon was up $420 and Apple was up $302. And like I say, for the week, the portfolio lost $230 instead of the expected $1,900. The top 30 equal weight, which is the same 30 stocks, except for you equal weight them, so you don't buy as many of the large corporations at the expense of the small. You just equal weight them. That portfolio fell $1,200. 1,195 to be precise, against an expected loss of 1,900. So it did a little better than the S&P, but much worse. If you look at the specifics in there, had 8 losers. ExxonMobil lost 106, Intel lost 107, Walmart lost 134, Coca-Cola lost 151, Berkshire Hathaway 167, Cisco 173, Bank of America 256, and JP Morgan 260. So again, the banking sector had 4 winners: NVIDIA, Adobe, and PayPal 190, 170, 143. 4 winners, and Amazon 140. Amazon's a story stock. It just goes up and down on sentiment, doesn't really correlate to any business marker. NVIDIA is on a tear. Just amazing. I mean, market was down almost 2% last week. It was up almost 5%. And in the 10 weeks since we created these portfolios, NVIDIA's up almost 30%, 29.4% over those 10 weeks. So NVIDIA's on a tear. But that's it for the top 30 equal weighted. Then you get to the top 3 by sector, which is where we include every stock. And we have the 3 finance stocks and the 3 industrials and the 3 materials and the 3, and that portfolio lost $2,500, $2,458 to be exact. But instead of only losing $1,900, it lost near $2,500. That stock had 13 losers: Lynn Corporation, Sherwin-Williams, Southern Company, Boeing, Walmart, Coca-Cola, Chevron, Berkshire Hathaway, Prologis, that's a real estate concern, ConocoPhillips, Honeywell, Bank of America, and JP Morgan. And the 13 lost $1,900 for the portfolio. Only had one large winner, which was Amazon, but only contributed 104. And it just dogged it. It had 33 stocks in it. 5 were up, 28 were down, and lost $2,500 for the period. Large liquid leaders, tough week. We lost net $1,200, $1,200.44, but $1,200. Biggest loser in the portfolio was Kinder Morgan, lost $373. But if you'll remember last week, I bought a bunch of puts on some of the stocks. And Kinder Morgan was one of the companies that I bought a put on. And so even though the stock was down $373 in our portfolio, the value of the put instrument that I bought was up $348. So $348 of our $373 was covered by the put instruments that I bought last week on that particular stock. Next largest loser was JP Morgan. Last week when I was discussing it, I made mention of the fact that I was thinking about putting JP Morgan, but decided to, as I said last week, let it go naked, not have a put or a call on it. That turned out to be a mistake. I should have bought the put options against it. It subtracted $334 from the portfolio. Behind them was 3M, subtracting $235. Honeywell subtracted $228. Pfizer subtracted $146. I talked a little bit about Pfizer last week. It was down, but so were 5 most of the stocks. So nothing statistically significant. I noticed in the paper this morning that one of the national health organizations is saying that the vaccines are no longer recommended for children. So that whole thing is starting, but so far the stock hasn't suffered. Lynn Corporation down 138, ExxonMobil, Air Products, Procter & Gamble, etc. Those all down. 9 stocks down, lost $1,804 out of the $1,200. Only 4 were up. Thermo Fisher, good gain. Last week I said I expected that one to claw its way back, and it's doing it. It was up 3.7% for the week as opposed to down 2%. Apple gained a little bit, and Philip Morris gained a little bit. But interesting. I had puts, those put instruments that I bought last week on 7 of the stocks that went down. And of those 7 stocks that I had the put instruments were down, there was $917 in losses total amongst those 7 stocks, but the put instruments covered $639 of the losses. And that brings us to this week and what I did. Again, the Fed didn't give me any clear direction. There was no clarity. They didn't, neither fish nor fowl. They didn't move this way. They didn't move that way. Some of the things they did said they maybe want to do. They provided no clear direction. I'm confused. That thing with the holiday just really surprised me. Makes me wonder about my news sources. I read the Wall Street Journal. I read various online articles from papers. I read financial blogs. I read news aggregation sites. If I get tired at the end of the day, just for entertainment, I may scan the headlines of the Daily Mail. I know everything about the UFO report that's coming out this Friday or whatever it is. Prince Harry and Meghan Markle. Just all this stuff, and nobody in any of those news sources gave me a heads up that there might, that we were thinking about a new holiday. That's incredibly deficient. I'm very but anyway, so I'm kind of stunned, and and I just based on the Fed not moving one way or the other, and based on me not. I'm just confused. I don't have, I can't tell you. I decided to extend the puts and calls to every element of the portfolio. I box the, the entire thing. Last week I did it with whatever it was, 7 stocks. This week I extended it to the full 21 that remain in the portfolio. Well, 20 at this point that remain in the portfolio. So I added 13. Interesting. What I'm doing is I want to be defensive. Okay. It's my view, in spite of my confusion, that in between now and call it Labor Day, Labor Day was the first Monday in September, but in between now and Labor Day, I expect that at least for some transitory period of time in there, a week, a month, 2 weeks, something, that the market's going to be down more than it is up. And for reasons that I discussed last week, if it goes up, it has to make a new all-time high every day, so on. I mean, or it can just, if it goes up, down, up, down, up, down, then it just sits flat. But I want protection in case it goes down in between now and Labor Day. Maybe by then I'll have a clearer understanding of what's happening. Maybe the Fed will clarify its positions as they started to do this morning. So I want to be defensive. I went and looked at the stocks, and only one of them was amenable to buying that protection with another put, like I did on the 7 stocks last week, and that was Facebook. So we bought a put on Facebook. And a put is just insurance. You pay a little money if the stock goes down. You get money. But the rest I had to do through call options. And we talked very briefly a few episodes ago about what a call option is, but we're going to have to go into some detail today. A call option is the right to buy shares at a set price on a set day. It has 2 elements to it. The most important is the set day. If I have a call option, it's its own security. Okay, it's like a separate piece of stock. Okay, it's its own thing. It has its own trading price. I can buy it and sell it separately without touching the underlying shares. It's its own thing. All right, it's its own piece of paper. It's its own security, but it represents the right to buy a stock. I want to sell these things, right? I want some money. I want some protection. So I'm giving someone the right to purchase shares of stock that I own at some future date He can't come to me, he can't have this piece of paper and come to me before that date and say, hey, I want your stock. Can't do that. Can't come to me after that date and say, oh, I want the stock. Can't do that on that day only. All right. So if we write this contract for August 20th or September 17th or whatever it is, on that day only, he can decide whether to buy it. Okay, so let's be hypothetical. Let's say I have a stock it's trading for $400 a share. Let's say I bought it at $375. All right, so I'm up about 7%, 6.7% on that stock because I bought it at $375. It's trading at $400. I don't really want to sell it, but I want some downside protection on it. So I go to this guy and I offer what's called a deep in the money call. I say, hey, I have this stock that's trading for $400. Do you want a right to purchase it from me on August 20th for $300 a share? And if he says, yeah, I say, okay, well, it's trading at $400. And I'm going to sign this piece of paper here, and it's going to give you the right to buy it from me on August 20th at $300. So you give me $100, and we'll make this piece of paper, worth $100. If I engage in that contract, if I have a stock trading at $4, and you have a right to buy it from me at $3, and we can agree on a price for this piece of paper, the right to buy that stock at $100, then that's what's called no premium, no discount, because it's just the trading price of the stock minus the strike price of the call option. If he says, no, I don't want to give you $100, I only want to give you 90, that's called a discount. All right, because I don't get my full $100 and I have to sacrifice $10 to get him to sign the piece of paper. That's called a discount. If he's feeling generous and say, I think it's worth 110, that's called a premium. All right, to the option price. But it all goes into pricing this piece of paper, which is its own separate security. All right, you can own you can own the stock and sell it. You can buy more of it. You can do whatever you want, and it doesn't have it. This piece of paper is independent until the day, the expiration date. In which case, if you sold the calls, you have to deliver the stock. Okay, so that's what I want to do. To cover a position, what you do is you write a deep in the money call. For example, I used a $400 stock and we sold it at $300. All right. 300 of 400 is 75%. So we got 25% of the value today. A $400 stock, we got 100 of it. So we got 25% of the value in cash today. And then a right for this guy to buy it at 300 at some date. And that trades on this separate piece of paper. Now, a couple of things can happen. Let's consider what happens if the stock goes up. Okay. If the stock goes up, it's trading at 400 when we create this piece of paper. This piece of paper we valued at $100. It trades on its own little exchange at $100. Price of the stock goes up from 400 to 410. Okay. That means the difference in between 410, where it's now trading, and 300 is $110. So on the exchange, this piece of paper we created, its price moves from $100, which is what when we signed it, to 110 to reflect the difference in between 410 and 300. And it keeps doing that. If it goes up like that, it keeps doing that. And if it goes up and stays up to the day and he calls the stock, what's the worst that happens to me? I collected the $100 that I got when we created this piece of paper. He has to buy the stock from me at the 300, all right, on the date because he wants to. This piece of paper gives him the right. So he pays me the 300 on that day. I make 400, but I only paid 375, which was my gain on the day that we created this piece of paper, right? So when you sell a call option, if the stock goes up, all you're doing is you're giving up the right to participate in any gains. You don't lose any money. All right, you can't lose anything because if this piece of paper goes up $10, the stock that I'm holding under here also went up $10, right? So this 10 offsets that 10, but you can't lose anything. If you bought it at 375 and you sold it in advance for 400, you still make your 6 point under the worst situation, but that's unlikely to happen all at once. And typically what happens is this thing will go up from 400 to 410, and this is if it's going up, from 400 to 410, and that'll make this piece of paper, instead of being worth 100 where I sold it, worth 110. But if I change my mind, I can go in there and buy it at 110, right? And I lose $10 buying it back, but I make $10 over here because I still own the stock, and the stock is up 10%. So all I'm doing is I'm foregoing any possible gain. That's the maximum downside, all right, of writing a deep in the money call. Now, what happens if the stock drops like I expect, or like I think will happen at least for a week or two or a month or something in between now and call it Labor Day? It was trading at 400. Let's say it drops to 380. This piece of paper that we wrote that I got $100 for, instead of being, the stock is now only 380, you have a right to buy it at 300. So this piece of paper, instead of worth being $100, is only worth 80. Yeah. And so I make my $20 here, but I lose my $20 on the stock, but I still own the stock. So I'm covering all my losses. All right. In other words, it's a wash. If stocks go down, I don't lose anything, because whatever I lose in the value of the stock over here, I make on my call instrument. So the trade is you forego any gains that might happen, but you're protected from any losses that might happen during the term of the call instrument. And I'm more comfortable with that right now. And like I say, I can change my mind and purchase them back, and maybe on one or two stocks at a time, whatever. But I can continue. I can buy them back at any time. They're their own piece of paper. They're separate from the stock underneath. But that's the way I'm most comfortable right now. And we wrote these call options, deep in the money call options, with virtually no premium or discount to the price, on Target, Philip Morris, ExxonMobil. Google, we had to sell. A call option or a put option, you have to do 10 share minimum. We only owned 3 shares of Google. They trade at like $2,400 a share, but you can't write a contract for 10 when you only have 3. You're speculating. So that stock I just sold. We wrote the put option on Facebook. Calls on Visa and on Thermo Fisher and on Lynn Corporation, on Verizon and on 3M and Procter & Gamble and JP Morgan and Honeywell. So of the 20 stocks that I have remaining, I sold Broadcom, which has continued to fall since we sold it. I sold Lowe's, which has continued to fall since we sold it. I sold Home Depot, which has continued to fall since we sold it. And just this week here, or last week, I sold the Google. So we started with 24. We only have 20 left. All the 20s are boxed, protected in some way or another. 11 of the 20 have call options on them, and 9 of them have puts. And we'll see how we proceed from here. Sorry to be so unclear, but I don't. My crystal ball's kind of foggy today, and like I say, I was just shocked that I had no idea that holiday was coming. It kind of makes me wonder what's coming next that I have no idea about. But that's it for today. Thank you for listening. It's Tuesday morning. Shows the Bogdanich perspective. We're at TalkCast PDX on the web at TalkCast PDX. And, if you have questions, comments, or suggestions, send them by email. Paul at stockbettor.com. That's Paul at stockbettor, BETTOR.com. And join me next Tuesday. And do widzenia. That means goodbye.